Welcome back to part 2 of our definitive 4-part masterclass series on structural credit engineering and raw ledger auditing. In part 1, we executed the baseline network isolation protocol by freezing the secondary data warehouses like LexisNexis and SageStream. By locking those background databases, we successfully cut off the external communication pipelines that the primary bureaus use to verify data. Now that your credit profile is isolated from its shadow backups, we can step into the core architecture of the banking system itself. Today, we are looking at the exact language that financial institutions use to transmit your personal identity and repayment data. We are throwing out the generic emotional dispute templates and learning how to look at your credit files like a software auditor. Most people look at their credit report and see lines of text, company logos, and a 3-digit consumer tracking score. But underneath that colorful consumer display layout lies a hidden data transmission blueprint called the Metro 2 electronic format. Metro 2 is the uniform software standard created by the Consumer Data Industry Association for all automated credit data reporting. Every single month, your creditors, regional lenders, and third-party collection houses package your data into a master file. This electronic file contains hundreds of tightly packed data blocks consisting of specific characters, numbers, and field markers. These data strings are transmitted via secure internet networks directly to Equifax, Experian, and TransUnion. Think of the Metro 2 format like an enterprise-level Excel spreadsheet that maps your entire financial existence across columns. There are specific columns designated for your exact account status, your current balance, your high credit limit, and your payment history. Because the global banking matrix relies entirely on speed, the credit bureau computers process these data packets automatically. The system demands absolute data purity, which means every single field in the data packet must match logically without contradiction. If one column states that an item is a collection but another column claims you owe an active monthly payment, the logic breaks. Under the absolute rules of the Fair Credit Reporting Act, all reported data must be 100% accurate and complete. But because thousands of independent banks and collection houses use cheap, outdated database software, formatting bugs are everywhere. When these legacy computers export your payment history, their software routines frequently inject massive formatting contradictions. In a normal reporting environment, the primary credit bureaus hide these internal mistakes by pulling patches from shadow networks. But because you executed the secondary freeze in Step 1, the Big Three bureaus are now entirely stranded. They are forced to evaluate the raw, unedited data packet exactly as it sits on their standalone corporate servers. When you strip away their background validation networks, their internal reporting errors become completely exposed to an audit. The absolute most common software glitch hidden on your report right now is the closed account active payment bug. When an account is charged off by a credit card lender or sold to a collection agency, it is legally designated as closed. When an account is closed, the historical reporting architecture requires specific fields to drop to absolute zero. Specifically, the data block known as the scheduled monthly payment amount must be cleaned and set to zero. If an account is closed, you no longer have an active, recurring monthly obligation under a standard revolving credit agreement. Yet, if you look closely at a raw credit report layout, you will frequently find a dollar amount still sitting in that box. A collection agency might buy a $500 debt and report the total amount in both the balance box and the payment box. This creates a critical system-wide logic contradiction that instantly violates the strict rules of the Metro 2 standard. The spreadsheet is simultaneously telling the underwriting computer that the account is dead, but that a payment is due tomorrow. This single, silent formatting mismatch systematically triggers an automatic risk rejection from machine learning lending models. The computer looks at that active payment code and adds it directly into your live debt-to-income ratio calculations. The system calculates that you have less disposable income than you actually possess, driving down your structural borrowing power. You are denied funding not because of your score, but because a legacy software routine failed to clear a data field properly. To identify these silent funding killers, you must stop looking at basic mobile monitoring dashboards and request raw paper reports. You need to see the side-by-side data layouts for all three primary credit bureaus to track the discrepancies column by column. Look directly at every negative account, charge-off, or collection line item and locate the scheduled payment field block. If the account status is listed as closed, transferred, or charged off, but that payment box shows a dollar value, you have caught the glitch. You have documented a direct breach of reporting standards that the data furnisher is completely unequipped to defend. Another massive electronic code mismatch occurs within the date of first delinquency field, commonly known as the DOFD tracking string. The date of first delinquency is the exact calendar day your account first became late and never returned to a current status. This specific date is the master timeline anchor that determines how long a negative item can legally stay on your report. Under federal consumer law, a negative account must be permanently scrubbed from your file after 7 years from that exact date. When a legacy debt collector buys an old account, their automated systems often input the date they purchased the debt as the opening date. This malicious software error completely alters the timeline, artificially extending the life of the negative mark on your record. If you cross-reference the original creditor's file layout against the collection agency's data packet, the dates will conflict completely. One bureau might show a delinquency date from 4 years ago, while another bureau shows a collection open date from last month. This is an absolute systemic contradiction. An account cannot experience its first historical delinquency after it has already been sold. You must document these raw field errors meticulously, creating an unassailable data parity log for your upcoming audit round. When you point out these exact character contradictions, you are not writing an emotional letter pleading for customer service sympathy. You are submitting a technical data parity audit that targets the software integrity of the reporting system itself. You write a factual, precise notification stating that the data packet fails the basic logical rules of Metro 2 transmission layout. You point out that the data furnisher is reporting conflicting values across mutually exclusive data blocks on the same account string. When the primary credit bureau receives this technical audit notice, their eOscar computer processes the specific field codes. The matching machine attempts to run a validation sweep, but it cannot resolve the internal arithmetic error on its own servers. Because the secondary background databases are frozen, it cannot find a third-party tracking anchor to bridge the logical gap. The Bureau's computer system is left with an invalid, contradictory data file that violates federal accuracy mandates. Under the strict liabilities of consumer protection statutes, if a reporting error cannot be reconciled, it must be removed. The Credit Bureau's internal software routine cannot maintain a broken line of code, forcing a total account deletion. This is how you leverage the structural programming rules of the banking industry to clean your files with absolute authority. You are playing a sophisticated game of data engineering, turning their own automated software standards against them. By cleaning these legacy database bugs, you restore the structural balance required by premium machine learning underwriting models. Tier 1 corporate lenders use automated engines that scan your profile for these exact baseline consistency signatures. When you eliminate formatting contradictions, your data profile mirrors the risk stability of an institutional asset vault. This opens up the path for massive corporate funding sequences, high-limit lines of credit, and strategic liquidity access. In Part 3 of this series, we will break down the exact mechanics of the electronic mailroom and the eOscar framework. We will show you how to draft the precise raw prose audit language that forces manual validation review from human compliance officers. But your foundation for success in the upcoming mailroom phase depends entirely on the ledger audit you perform today. Take absolute control of your data files, check your closed account fields, and locate the silent software glitches this week. The masterclass continues in Part 3, where we weaponize the processing vulnerabilities of the credit reporting agencies themselves. Get your data logs ready, trace the formatting contradictions column by column, and prepare to move your profile at true system speed.